Hey everyone, Logan Hertz with Hazeltine LLC. We are continuing our series of interviews with people in the financial sector with a lot more credibility and a lot more experience than myself. And we're super excited to have with us today Mr. Sebastien Boyer, also known as the Approved Guy. He is a financial coach. He specializes in personal credit, especially business credit, business financing, velocity banking, and infinite banking. And we're very excited to have him with us on the show today. Sebastian, how you doing?
I'm doing excellent. Thank you, Logan. Thank you for having me.
So tell us about your business, about your why. What is it that you do? Why do you do it?
Certainly. So first, going back about 13 years, I joined teamed up with my brother, who started a business finance company called OrangeFi, and we started helping people get access to funding. The why at that time, honestly, God's honest truth, was just it was a way for us to make money in an honest way. And we also saw a need in the industry for education. So we started a business credit course called Business Credit 101. So for about 5 or 6 years, that's where I was really focused, going back 13 years ago. And it was really just helping folks get access to funding to start, to grow their businesses, to refinance bad business debt. And along the way, I met a young man named Denzel Rodriguez. This was about 6 years ago. And Denzel and I actually met on a networking platform pre-COVID, where it was like a speed dating networking thing. So it was like you had 5 minutes to connect with somebody. I literally spoke to about 150 people that day. He's the only one that stuck, that, it was like a light bulb went off. This person and I, we had the same, we're kindred spirits, right? And so we're at the same, but he was teaching velocity banking. Never heard about that. Didn't know what that was. I understood debt elimination strategies like that snowball and other, weight principles of just being a good steward, but I didn't hear or understand that. So he taught me that. He became my coach. I started practicing it, and then I started teaching velocity. Now, right around the same time, I got a license for life insurance. Something in me told me this is really my future, and what I want to do is to help people to set up themselves and their families for generational wealth, to protect their money, and also to teach them how to protect their assets. And so yeah, so uh, for about 2 or 3 years, I sat in rooms with different companies that had recruited me as an agent, and all they were talking about is the IUL product, and building teams and recruiting and making all this money, but no one actually took the time to really um, teach the ins and outs of these products, the pros and cons of these products, and where the real value is for the consumer. Except for that, before they met you, they had no insurance, and so no matter what it is that you get them, they're better off after they met you, because it's better to have some insurance than no insurance, regardless of what that insurance is. It didn't sit right with me, didn't feel right, and I couldn't didn't feel good about the IUL product, didn't feel good about the strategy of buy term and invest the rest. Something was wrong there as well. And so for many years, I just didn't do anything. With that license and with insurance, I just listened and listened and listened, and to the point where eventually I knew exactly what I didn't want to do. And then I met Chris Kirkpatrick, which is the owner of Life 180. And Chris enlightened me. He became my teacher and my mentor in that space. And he taught me the ins and outs of IUL and whole life insurance, the difference, and how to properly design and how to properly structure insurance policies for the infinite banking strategy. So not to get too personal and emotional, but about, well, November 2022, my grandmother passed away. She was the person who raised me along with my mother. Around right that same week, my mother unfortunately got a stroke, and the when we buried my grandmother, the financial advisor that had helped her, he had set her up with one of those buy term invest the rest strategies. So I'm not sure where the invest the rest went to, because there was nothing in the market. I don't know what happened there. But in the end, she outlived her term policy. And there was nothing for the family to use to even help pay for the burial expenses, right? And that was frustrating, because that's the last thing you want to be worried about when someone you love passes away, is, how am I going to pay for these expenses and settle her obligations, right? Unfortunately, my mother didn't really recover from the stroke. About a year passed, and she just got worse and worse. Actually about 3 months after, she had to move in with me because she was unable to care for herself. Now, because she wasn't taught properly and educated, she didn't have the right policy or insurances in place. And so there was nothing that we had available that could help us pay for her care outside of just Medicare, which does not pay for in-home care. And so I became her caretaker. And, I see that as a blessing, but at the time, didn't feel like a blessing. It was extremely difficult. I never imagined I'd have to care for my mother in that way. And it created a lot of stress, a lot of anxiety, a lot of time spent out, not working, not building my company, not spending time with my children and my wife, but just taking care of my mom. We didn't know, but until around April this year, the diagnosis was that she had pancreatic cancer, stage 4. It had spread to all her organs, and a month later, my mother passed. That was May 30th this year. So we had our funeral just about 2 weeks ago. Again, nothing in place, right? So not only were we not able to get access to anything to help care for her that could have really helped me help her to have a better standard of living for the last year of her life and really minimized the overall stress that it caused in our family. But then again, there was nothing there, right? So like I said, I know what I don't want to happen to my family. And with that experience, I know what I want to have in place for myself. And unfortunately, what I realize is that many people don't have these basic things in place, either out of fear, either out of just overthinking and just so much information, and they don't know what they should or shouldn't do, or just they don't realize the value of it and that they think they don't need it, especially younger people. They think it's not something they need. And so I have a true experiential passion for the value of a death benefit, for the value of living benefits that are inside of a life insurance policy. And of course, those to me are like the most important parts, where before the most important part was the cash value of a life insurance policy and what you could do with it. And the death benefit and the living benefits were kind of secondary, right? But now with my experience, it's the reverse. And I appreciate the cash value portion because, of course, that should be your foundational, in my opinion, your foundational account that you move all other accounts through, because then you are giving every dollar multiple jobs, and you're growing an account that on the tailwind is going to grow for the rest of your life, and then still give you those living benefits and the death benefit. So I know I said a lot there, but at the end of the day, I believe in God, and I believe that what I'm doing as far as teaching the information that I'm teaching and helping people, that it aligns with God's will, which is to do good and help others. That's what the Bible says is all of our purpose on earth as human beings, is to do good and help others. And so though my brand is the approved guy, I have a website, which is wholelifesavingsstrategy.com. And my team that I'm building of agents that are like-minded, that want to kind of follow the teaching and the approach, is the Kingdom Finance team. And so yeah, that's my why. It's a true passion to serve God and serve people, and to shed light on a lot of false information, and just help people to make good, sound financial decisions that are going to benefit them and their children and their children's children.
Boy, there's so much there we could respond to. I think it's unfortunately true that a lot of people in the business had to learn these things the hard way. They don't teach you about this in the standard financial wisdom, if it can be called that, doesn't involve whole life insurance, whereas it used to be the bedrock asset, right? Prior to the 1960s, your average American household had whole life insurance, right? And since you got a little bit preachy, I'll get a little preachy too. It's like, well, first of all, in my opinion, if you want to boil it down to the simplest terms, the difference between term life insurance and whole life insurance is that whole life insurance pays, term life insurance doesn't, right? In over 98% of cases, no death benefit will ever be paid on term life insurance. And if it is paid, it's because there's something tragic happened. With whole life insurance, it will be paid no matter what. That death benefit is real. It will be paid, and you can use it while you're alive in terms of the cash value or in terms of um, a chronic illness rider should you need it, right? So we pay death claims. Term life
Yep.
insurance doesn't pay, right? And then the other is, I'm glad you're bringing this up, because what we do is we protect widows and orphans. What those who propose the buy term and invest the difference crowd, and I get called a lot of names, and I'm sure you do too. So I feel like I have to play a little bit of offense instead of playing defense. What they do is taking advantage of widows and orphans.
Yep.
They make sure that widows and orphans are not protected.
Yep.
And with the money that they could have used to protect themselves, they then go and play with it in the market where, to your point, I've never seen it really pan out. I'm not saying it can't pan out. I'm not saying that. I just, from the people I interact with, I don't meet people who are in love with their retirement accounts. I don't meet people who got rich because they had mutual funds. I don't meet people who are, super confident about retirement because they put all this money in the market. I don't meet those types of people.
Yeah.
So something we were talking about a little bit beforehand along those lines is what we do, and we'll get into maybe defining it, but what we do is infinite banking and velocity banking. That's part of what we do. That's the main thing that I do is infinite banking, and then also velocity banking, and you as well. And one of the things that I've noticed is just how people who are opposed to those strategies can't seem to have a rational discussion about it. I mean, the name calling and the just vitriol is just off the charts. And I don't understand why,
Yeah.
if we're just disagreeing over what's the right financial strategy, I don't understand why there has to be so much vitriol. Can you talk to that at all, Sebastian?
I just think it boils down to people's emotional attachments to their perspectives and ideas. It's just like religion. Even within the same faith, you have so many different perspectives. And when people become emotionally attached to their perspective, then they're unable to think logically or reason logically, and just have a decent conversation, whether it be a political conversation, religious conversation. I mean, look, I started my daughter in a homeschool program because for the first 6 years of elementary school, towards the end, during COVID, they did everyone had to do homeschool, and she did great, and she did really well during that time. It's not for everybody, right? Most of the kids in her class didn't do well, but she did. She thrived in that environment, and she asked me, "Hey, Dad, can I continue to do homeschool virtually because I feel like I'm learning better and I'm progressing faster?" And I said, "Okay, let's look into it." So I got her into that. You don't know how many people, emotionally and angrily, teachers, family members, attack me because my daughter's not in a public school or in a school where she's interacting with kids and all the quote unquote statistics and this and that and the other. And I'm just like, hey, look, I get it, but for my daughter, this is working. It's not going to work for every child, right? And that's the thing. It doesn't work for everybody. Velocity banking doesn't work for every single case,
Mhm.
because it's based on your cash flow, based on your income, based on your credit, what you can get access to. And we have to look and see, does this make sense? Or should you just stick to a traditional debt snowball method, right? Which is
Mhm.
good, which is perfectly fine until perhaps you can get yourself in a position to practice the velocity strategy. But it's not like we're saying, hey, everybody stop what you're doing and do velocity banking
Right,
regardless.
right.
And I think that's the problem. I think the people that are coming against us, they think that we're just saying, hey, look, this works for everybody every time, without a doubt. Stop what you're doing, do velocity. And
Mhm.
it's not true. It doesn't work every time for everybody. And that's why when I create content on it, I try to keep it very basic, more of like introducing the strategy. We're going to get more advanced on a one-on-one based on your circumstances, right? I actually had someone make a comment to me the other day. They were like, "Oh, I see you put out a video, Velocity Banking 101. When are you going to put out the advanced version, Velocity Banking 202?" And I literally replied, I said, "Hey, I'm not. That's not ever going to come out, because if I do, then somebody who has no business playing ball on that court is going to end
Mhm.
up hurting themselves because they're going to start trying to do things that they shouldn't be doing." And they're now, of course, if they call you, me, you For coaching, we can talk them through that, but not
Right.
everyone's going to do that. There's going to be a lot of people that just watch content. Oh, you know what? Let me go do that. Right.
Mhm.
And I don't recommend that, people. Like, folks, I do not recommend blindly just jumping into a pool empty. You should not do that. If you've never, you know, thought of these strategies and you're hearing them for the first time, even if you've been watching, you need to speak to someone that is trusted, that has your best interest in mind, that understands these strategies to walk you through it and make sure that you're going to do it properly and that you should be doing it based on your circumstances. So I think that's what it is. It's an emotional attachment to a perspective. And then it's the idea that we're saying this is for everybody, you know, blanklet, just stop what you're doing, do velocity. And I definitely don't preach or teach that. I think that we have to look at every case. We have to really look at your numbers and see if it makes sense. And like I said, sometimes it's better to start taking a step back and crawling before you walk, before you run, before you fly, right? And so that's what I think it boils down to, is just that, you know, that perspective and the need to defend that idea that, you know, whatever they're doing worked for them, and therefore what you're saying is different than what they did, and therefore you're wrong.
Yeah, there's a whole lot we could talk about on that. It'd be an interesting conversation, but probably not one that would benefit the audience too much. We then start psychoanalyzing this sort of criticism, if it can be called that,
Yeah,
right? So well, let's go back to the basics then, because I think it always does go back to the basics, right? Um, I did strategy consulting with Fortune 500 companies for over 10 years, and a lot of really smart people in the room. And the best strategies are simple and they are fundamental and they're based on very basic, sound principles. They're not over engineered, they're not complicated, right? So let's start with the infinite banking concept. That's
certainly.
primarily what I do. I
Mhm.
know you do that, you practice as well. So, Sebastien, what is the infinite banking concept to someone who's never heard of it?
So first of all, the words infinite banking were made popular by Nelson Nash. He didn't create infinite banking. I wouldn't even say he discovered it. He just packaged it. And in his time, in his generation, he was the leader in this space as far as, you know, teaching and educating people about the strategy. It's like gravity. You know, Isaac Newton did not discover it. It was there before. He just realized it and then gave it a name and stamped it. And now we think of Isaac Newton as the one who discovered gravity. No, it was there before. He just identified it, right? So infinite banking, to make it simple, is using the only account that you can store money in, grow that money tax free. And that's the key component, one of the key components of infinite banking. And that's going to be within a life insurance product, right? But it cannot just be any life insurance product. It has to be the right product with the right company and the right agent who knows how to design it and is willing to design it in a way that benefits your purposes versus their pocketbooks, right? Because that's the other thing. Even within whole life, I've seen policies where people are talking about infinite banking and they're structured to increase the commission of the agent, not to give the client the best cash value or the best, most efficiency based on their needs. So ultimately, a properly designed whole life insurance policy with a mutual company where you are able to design the policy for max cash value. I prefer a non-direct recognition insurance carrier because they ignore the loan and there's uninterrupted compound interest growth. And with these policies, you're simply allocating a minimum premium, and the majority of premium goes to cash value. Minimum premium goes to the cost of insurance, and the majority of the premium goes to the cash value, what I like to call the savings bucket or the savings vault. So my little website there, Whole Life Saving Strategy, that's exactly what I call it. It is a whole life insurance saving strategy where you're using a whole life insurance policy as a savings account for your money, not as an investment account. And I think that's where other people get confused about this strategy. This is not an account for you to invest your money to become rich and wealthy. This is not going to get you rich and wealthy. Maybe you might leave a death benefit that will help your children and your grandchildren become rich and wealthy. But in your lifetime, your wealth is probably going to be created in your activities outside of your policy, but you're using your policy in conjunction with those investments outside of the policy. So really, it's a savings account that's built inside of a whole life insurance policy that's protected by the death benefit, and you have access to borrow against the cash value. And I always stress the word against the cash value, not from the cash value. Like equity in real estate, if you get a second lien HELOC, you're borrowing against the equity. And so the same thing, the cash value is like equity in the life insurance policy that you can borrow against, put that to work, pay off debt, pay for your kids' college tuition, put that in your investments in the stock market, in real estate, whatever you want to do. And ultimately, the banking system is one where you create an account, you fund the account, you borrow from the account, and then you pay it back. And that's another key component, is paying back the policy to complete the cycle. So ultimately, what makes it also very attractive is that the loan that you borrow against the policy, there is no due date or term on that loan. So it's an open-ended schedule as far as how you pay it back. Now, there is interest, so I always advise clients, make sure you pay your interest. Do not let that compound against you. But the principal, you have some flexibility, right? So with that in mind, I recommend and I teach that you should treat yourself like a bank does and create a payment schedule. Treat yourself like a bank. This is your bank. This is the bank of Sebastien, right? The bank of Logan. So ultimately, I do want to create a payment schedule, but if I have a bad month or a bad quarter or a bad year or a bad century, I have flexibility, right? And that is something that can give you peace of mind, because now, especially if you're using it as part of your debt strategy to eliminate debt, you can transfer the debt ownership from vendors, creditors, and banks to your policy and give yourself a little more flexibility on how you pay it back to your policy. So infinite banking, when it comes down to it, is a high cash value whole life insurance policy with a mutual company, properly designed for the purpose of creating your own banking system. And when done right, when practiced properly, if you set up a trust and you can make your trust the owner and the beneficiary of the policy in your trust, you can also then create if-then statements and rules. And one of those rules can be that your children or your grandchildren, your beneficiary, that is going to receive the funds through the trust, not directly from the death benefit, because the death benefit will go to the trust, but through the trust, is that they then have to take X amount of dollars and purchase their own policy and perpetuate the cycle. So now, perhaps in my lifetime, I am a working class American, and maybe I can only afford and I can only save in my lifetime a policy, and with my investments and income, they may leave behind a $2-3 million death benefit, right? But if I then advised or created that rule in my trust for my daughter or my son to then take $200,000-300,000 and purchase a $20 million death benefit. Now, my grandchildren, when it's time for them to buy a car, buy a house, they don't need to go to Bank of America, right? They can just go to the Boyer Family Trust and borrow from the family trust, because we've well funded that trust over 2 to 3 generations, right? And so ultimately, for me, that's what infinite banking is. It's the ability to create the banking system for yourself, to borrow and leverage while you're living, but it's the tailwind effect that you create over the long run of saving the money in the account and building the cash value, but ultimately the death benefit and the generational wealth that you create for your children and your children's children.
Yeah, there's so much there to get into. Maybe we'll have to do a different video on it, but I like that you made the distinction between infinite banking and whole life insurance, because a lot of our opponents and a lot of people who just quite frankly, don't understand and don't want to take the time to understand it, think infinite banking equals whole life insurance. Not true, right? Whole life insurance may be the vehicle that we're using, but it has to be designed in a certain way. But more importantly, it has to be utilized in a certain way, or it's not really infinite banking. And to your point, it's going to be a system. It's not going to be
Right.
one policy. You're
Right.
going to have a system, right? Just like owning a house doesn't make you a real estate investor. If you have a house, well, the house by itself means nothing, does nothing for you, right? But if you utilize a portfolio of real estate as part of a system, you can become wealthy by doing that, right? And of course, infinite banking, to your point, by itself is not going to make you wealthy. What it will do is accelerate everything else you're doing, makes everything else in your personal economy that much more efficient. And that's why it's oftentimes difficult to show the value to infinite banking, because it's not the whole life insurance policy per se that's going to make you rich. It's how it makes everything else in your personal economy so much more efficient, so
Right.
you can make the full use of all the money that flows through your personal economy, right? Because you have this bedrock asset in the system of paying premiums in, borrowing policy loans out, paying them back in. Meanwhile, the whole principal balance keeps earning, right?
Correct. Yeah.
So infinite banking doesn't equal whole life insurance. Just like, this is my segue now, having a HELOC doesn't equal velocity banking, right? So
Correct.
another strategy that both of us do, and you're probably more of an expert on it than I am, is velocity banking. And just because you have a HELOC doesn't mean you're doing velocity banking, right? A lot of people get obsessed in the HELOC versus mortgage and that argument, and either one could be fine,
Yeah.
but velocity banking is more about how are you making a strategic use of a particular debt instrument.
Correct.
So with that segue, Sebastian, you want to define for us what is velocity banking?
Certainly. So velocity banking, for me to properly explain it, I have to start by saying it is really nothing more than adding speed to an existing debt elimination strategy, such as debt snowball or debt avalanche or cash flow index. So debt snowball, I'll start there, is simply taking your income and cash flow and paying it to the lowest balance debt that you have. Simple. When you pay that debt off, the cash flow and income that was going towards that debt is then reallocated to the next debt. So therefore you snowball, right?
Mhm.
So avalanche, that method is also snowballing, except it's looking at the highest interest rate versus the lowest balance. And then the cash flow index is an algorithm that looks at what is going to release the maximum cash flow, but you're still snowballing. You're still moving and reallocating income and cash flow from one debt once it's been paid off to the next debt. So at the end of the day, it's all snowball. It's just what's the hierarchy, whether it's standard snowball or avalanche or cash flow index. So first of all, we're all going to be doing that if we're attacking debt. That's the basic fundamental principle of it. And of course, knowing your numbers, knowing your debts, your interest rates, separating that from your expenses, identifying where you're overspending unnecessarily, closing those holes and gaps, and being efficient and being a good steward of your money, having a purpose and a use for every single dollar, so that that dollar is not just going to be spent frivolously without any purpose or intention. Being intentional, right? So that's the base foundation. So for everyone and anyone who hates the idea of velocity, that is the basis foundation of velocity. Now, when we add velocity to this now, that's all we're doing. We're just taking this and we're going to try to speed it up. And how can we do that? We can do that with an open-ended, simple interest line of credit. That's it. Now, that can be a personal line of credit. It could be a business line of credit. It could be done with some credit cards, especially if it's 0% interest promotions for certain times. But it's very limited. This credit card part of it would be more of a supplement to kind of help out in terms of cash back rewards, travel points, and things like that. But really, you need a bigger line of credit. So even a personal line or a business line sometimes is difficult to work with because it might not be big enough. And that's where most folks are really going to benefit from a home equity line of credit, because typically there you can get a line of credit that's going to be in the size of 100, 150, 200,000, and versus maybe just a 20 or $30,000 line of credit, right? But the reason it's working is because that line of credit, that home equity line of credit, is an open-ended, simple interest line of credit. right? So open-ended means that you don't have a term to pay back. You don't have to pay back what you draw in a 6-month window or a 12-month window. Like a credit card, you can pay a minimum payment. But whatever you pay immediately goes back to the available line of credit. It's revolving. So you can use it again and again. So that's the number one feature we're looking for. Number two feature, of course, the interest rate on that line of credit does matter. We definitely don't want to be getting a line of credit with 15% interest. That's going to be very difficult to make use of. We want to get a line of credit that's relative as low as possible, relatively low compared to your existing interest rates, right? Now, it doesn't have to be lower than your current interest rate. If you have a debt that's, let's say, 7%, and you're getting a line of credit that's, say, 8 or 9%, you can still outperform that 7% debt with a line of credit, right? And of course, if it was equal, you're definitely going to beat it. And of course, if it's lower, then that's a no-brainer. That's just a simple debt consolidation, right? So simply put, that line of credit is calculating interest daily, simple interest. There's no amortized schedule on that line of credit, where most debts, such as a mortgage, car loans, student loans, they have an amortized schedule. And so what that means is that all of that interest is being paid up front on that loan schedule. And the principal is not barely being touched for, until the end of the term of that loan. And so unfortunately, what that pretty much means, just to keep it simple, on a 30-year amortized schedule, it's almost like you're paying your loan twice, once to the bank and then once to and second to the principal. And so if you only paid the minimum payment, everybody's looking at that interest rate, especially when they were at 2 and 3%, and they're like, "Oh, I have a 3% APY." But that doesn't mean you're paying 3% over a span of 30 years, because you're not, because of the amortized schedule. If you look in the fine print, it actually says north of about 100%. And that's because with an amortized schedule, that's the APY yearly, but that amortized schedule with how you're paying that interest back. And I'm sure we can run simulations to show people this.
Yeah, yeah. And Sebastian, we're coming towards the end of our time. There's so much more we need to talk about. So what I want to talk about in our next video is we'll talk about infinite banking and velocity banking and how they work together,
Okay.
which is just so much more powerful. And I know as you're talking, there's so many things we could get into. So I hope this is the first of many, many, many videos. But Sebastian, thank you so much for coming on the show, sharing your story, and explaining to our audience some of the basics about infinite banking and velocity banking. We greatly appreciate your time.
Of course. Thank you. Looking forward to the next time.